Now, how we calculate the taxable income is as simple as that. They say that start from the financial statement, which is prepared based on the standard principles. That means using the IFRS standards and actions are being taken. And then do an adjustment, some adjustments which are being expected to be done. Now, there is a interesting section which has come, which says that unrealized gains and losses. Now, unrealized gains and losses can be under two categories. One is you have capital asset, and one you can be having a revenue items. Now, capital assets are items which are technically long-term impact on business. They include asset, machinery, long-term liability, loans to buy property, etc. So all these are capital items which we talked about. Now, in this case, unrealized gains or losses and capital gain item are not taken into account while calculating the taxable income. So if you reevaluate any kind of a capital asset, you may not have to pay a taxes on those cases. But if those items are revenue item that are short-term impact on the business, revenue assets are other than capital assets which we referred to. In this case, even unrealized gains or losses on revenue item will need to be taken into account while calculating taxable income. So a typical example, revaluation of stock. So if a revaluation of stock happens, it becomes part of the taxable story. If it's a revaluation of capital item, it may not attract the corporate tax as we talk about. Subject to certain conditions. If you are reevaluating, you will not reevaluate from the tax perspective. That means when the taxes has to be paid at a later stage, will be considered in a different action plan. Then what we do, there are some exempt income. That means income which are not taxable. So you make adjustments on that. There are going to be expenses where there is a deduction limitations or there are deductions or expenses not allowed. You have to make adjustment on that. And the last is losses limitations. So if you are having a group company or a parent structure kind of an entity, what happens on those structure and what kind of a loss limitation you can take, that also becomes part of it. So we are going to do or review each section in little detailed way and see how it gets attracted. That's how you calculate your taxable income. So now what we are going to look at is, let's look at exempt income, which are the exempt income category. Now there are three broad exempt incomes which are being defined. Exemptions from dividend and capital gain, foreign branch profit exemption, and other exempt income. We'll look at first exemption for dividend and capital gain. In this case, all domestic dividend earned from a UAE companies, including dividend paid by free zone person, that benefit from 0% corporate tax regime. So any dividend you receive from a UAE entity, you don't have to ponder around whether this is taxable or not. It is going to be a taxable at a 0% corporate tax rate. So we are calling it exempt or 0% corporate tax is what we need to differentiate. It's a taxable but zero rated. So but they are exempt income from company's corporate tax perspective. Next comes dividend paid by foreign companies and capital gain from sale of share of both UAE and foreign companies are also exempt from corporate tax, provided certain conditions are met. Now, dividend by foreign company, that is the first category. If you see the first category, we're seeing dividend from any UAE company. So any dividend from foreign company comes to the second category. However, capital gain of UAE entity and foreign company are in the same bracket. So the second bracket, if you see, there are 2 points, dividend from foreign company and capital gain from sale of share of both UAE and foreign company will be part of it. Now, what exemptions or what conditions need to be met? UAE shareholder must own at least 5% of the shares of the subsidiary company, minimum 5%. Foreign subsidiary is subject to corporate tax at a rate of at least 9%. So if both these conditions are met, then only you can call it exempt. If you are owing less than 5%, you cannot take that benefit. If the subsidiary is not subjected to corporate tax or is subjected to less than 9% corporate tax, you cannot take this exemption of dividend from a foreign company. So both points have to be looked at. That means the first condition, ownership should be more than 5%. Second condition, from where you're getting a dividend or capital gain, should be subjected to at least 9%. We'll talk about a free zone. There is a good catch which comes from a free zone perspective and quite interesting also. Now, capital gain on disposal of shares in free zone will be exempt from corporate tax, where the free zone person is a holding company and substantially all of its income is derived from shareholding in subsidiary company that meets the participation exemption condition discussed above. So if you are a free zone company, that means free zone is a holding company, and you have a company in the mainland, then free zone company must own at least 5% of its share in the subsidiary company. That's the first condition which you saw in the previous example also. And second is, since the company is on a mainland, it is anyway subjected to 9% tax. So if it is subjected to 9% tax, then any income earned or received by a free zone company in form of a capital gain, I'm not talking dividend, there is a difference. Dividend earned by a free zone is under zero rated, which is on the first point. Capital gain, which is in parallels with the foreign companies, has to comply to the second condition. So if you see the conditions are same, so they are considering any income earned in UAE by either a mainland from a mainland company or from a foreign company for a free zone is considered as similar lines. If you read a pretext to the law, it looks confusing, but if you just break it down, it's quite simple and quite logical also, I'll use the word. Just a quick snapshot, domestic dividend, foreign dividend does not make a difference. So any dividend paid by a free zone also, domestic, when I'm talking about the domestic dividend, I'm talking about a UAE dividend. So any dividend received from a UAE entity by a UAE company, whether in a free zone or outside, is not going to be taxed. That means 0%. Dividend by a foreign company, paid by a foreign company and received in UAE, and capital gain from sale of shares in both UAE and foreign company will be exempt from corporate tax provided 5% plus shareholding and should be subjected to 9% plus tax in that jurisdiction. Coming to foreign branch profit exemption. So in this case, a branch is not a separate entity, we all know, but an extension of its parent company. Now, where and why we are calling it a foreign branch profit exemption, because again, there are certain conditions which need to be met, which is quite logical. Recognizing the potential complexities associated with attributing income and expenses of foreign branch, UAE company can either, one, claim a foreign tax credit for tax paid in the foreign branch country, or elect to claim an exemption. Now here, elect to claim an exemption for a foreign branch profit. So again, you need to apply for exemption category kind of a thing, and you can elect to. Otherwise, you can consider the foreign branch profit also and get a benefit of whatever credit, whatever foreign taxes you have paid to get into your calculation side. The election to claim branch profit exemption is proposed to apply to all foreign branches in UAE company and will be irrevocable. So once it's done, technically it's done. The exemption for foreign branch profit may not be available where the foreign branch is not subjected to sufficient level of tax in the foreign jurisdiction in which it is located. So if you have a foreign branch and there are no taxes or less taxes, then you may not be able to get the exemption as stated in this. Again, logic is either you pay taxes in the foreign branch and take a claim credit, or you claim an exemption, but exemption will be only available when in the place where the foreign branch is located, there are sufficient taxes which are being deployed. Other income, now they're very specific on leasing and logistic kind of activity. So they said operating or leasing aircraft of ships and associated equipments. So they have taken this as out of the preview from a corporate tax perspective, and the logic is also correct because UAE is a major logistics center and international travel hub, UAE corporate tax regime will exempt income earned from by a non-resident. So it's an income which is earned by non-resident from operating or leasing aircraft or ship used in international transportation. Provided the same tax treatment is granted to the UAE business in the relevant foreign jurisdiction under reciprocity principle. So technically, we are talking about if that country gives that same kind of a principle, we will apply the same principle from a UAE perspective also. Let's jump to the next section, which is expenses deduction limitations. So there are limitations which are there from expenses deduction also, which we are going to look at. One is interest capping rule. So they have interest is quite considered under the BEPS framework, base erosion profit shifting framework, as a tool where income of one location gets transferred to the other. So that is the reason they refer to this section. First, they talked about a standard method. So standard method is interest is capped up to 30% of EBITDA. So earning before interest, tax, depreciation, and amortization. So EBITDA is what, if you up to 30%, you can always look at it. And there is going to be a provision of fixed amount. Although in consultation document, the fixed amount is not being referred, but it is said that they don't want to make it an administrative burden. So they may come up with a fixed value stating that up to this much of dirhams, you will not be subjected to calculation whether the interest is within the threshold or not. So anything which is higher or above can be taken. 30% of EBITDA or fixed amount will be considered from a calculation perspective, which you can claim. If fixed amount is less, then you will use that only. So that's where it comes. So, but maximum what you can claim is you cannot claim more than interest. So that's a given fact. So this comes from Action 4 of OECD, that is base erosion profit shifting framework, which is looked at. Now, special method, again, there are going to be a special method which is at a group level. Now, group definition again being defined at a later stage, which we are going to refer to. They will have a different interest capping method using group's overall position. So that can be used and can be looked at, which is again at a group level. Now here the catch or the cap is interest paid to related parties. Borrowing should be at arm's length. So transfer pricing principle comes into play, where such borrowing are used for certain specific intra-group transactions. They need to look at. Related party interest will only be deductible. Now the deduction limitation itself is brought up if there is a valid commercial reason for obtaining the loan. It should not happen that I'm just giving a very vague example, but we have seen in a couple of cases which happened. You already sitting on a surplus cash, still you took a loan and you're paying interest. So it doesn't make any commercial sense why this money is being kept, unless there is a regulatory requirement to keep that kind of a deposit and all those things. Otherwise, the commercial sense does not come and does not prevail. The valid commercial reason will be considered to exist if the related party lender is subject to corporate tax or equivalent tax at least of 9% on the interest income earned. So if RP is earning an income and you are paying expenses here, that's fine, which is perfectly fine. But at least 9% of the taxation should be there on the other side of the fence. Next comes there is an exemption which is being given very clearly because the interest is a major factor for those businesses. One is bank, insurance business, certain other regulated financial service entities, and business carried by natural person. So for natural person also 30% cap is not there. So if there is any sole establishment kind of a category, then again 30% EBITDA cap, which we referred to, will not apply. So this is where there's a differentiator. So you have a standard method, you have a special method, you have an exemption, which is given from an interest capping rule perspective. Okay. Now there are expenses which are designed and defined as which are non-deductible expenses. Let's look at what we referred to in the previous slides also, but just bringing it back. Payment made to a free zone person that is taxed at 0% on receipt of income will not be deductible for corporate tax. You remember we have referred this. I just pinned the slide itself here. So you will not be allowed to get that expenses. A related party will be allowed to claim a deduction if the payment is attributed to mainland branch of a free zone person. So that's where deductions or exemptions are played into. Now here, businesses are allowed 50% of expenditure incurred on entertainment. Now this entertainment can be on customer, shareholder, supplier, and other business partners. Definitely business purpose has to be there. You need to establish that this was done in a right and from a business purpose. Still, if it's an entertainment, prove that this is a right entertainment from a business perspective. 50% is what deduction is allowed. So 50% will be added up in the income for a calculation of taxes. So that's where non-deductible expenses comes. No deduction allowed for certain expenses or specific expenses such as administrative penalties. So if there are any penalties, fines which are there, you can't take an income tax benefit. Recoverable VAT. So any VAT which is recoverable. Now this is quite interesting point. Whether you recover or not is not the point which they are referring to. Anything which is recoverable cannot be claimed. Now it's again an important part from a VAT stroke corporate tax perspective that VAT input tax should have a different sections. VAT recovered, VAT recoverable but not recovered, VAT not recoverable. So all the three different heads should be looked at, because corporate tax is not going to allow recoverable VAT amount. And the last section is donation paid to an organization that is not an approved charity or a public benefit organization. So donation paid to approved institutions is fine, but not approved will be written back and you will add up in the income side. So those are some of the expenses which are not allowed. And then comes a losses limitation. Now this is quite interesting and it adds up quite an element on the group entities also, how these group entities are treated. Now business will be able to offset a loss incurred in one period against the taxable income of future period up to a maximum of 75% of the taxable income in each of those future period. So how much of losses we can absorb is up to 75%, not beyond that. So 25% losses, you will not be able to set off the corporate tax. Tax loss can be carried forward indefinitely provided. Now there are two conditions they have said. The same shareholder hold at least 50% of the share capital from the start of the period of a loss is incurred to the end of the period in which loss is offset against taxable income. So as I said, KYC is becoming important. So UBO is becoming important. So when you are identifying the same shareholder, you need to look at a UBO, not the primary parent entities or not the primary entities. So ultimately, who owns, how much own, and how much is the shareholding at the time when the losses started happening, and what is the time when the losses offset is happening. If there is a change in ownership of more than 50%, tax loss may still be carried forward provided same or similar business is carried by the new owners. Now this is a transfer of business condition which we are looking at, which comes into category. So if it's not the same ownership, business cannot be changed. So the moment you change a business or a type of business or the constitution of business, again the problem comes into. Now there is one exemption which they are given. This will not apply to any listed or recognized stock exchange. So for listed recognized stock exchange, they are not looking at change in ownership structure. That's what they're not doing it. So a very important concept which comes on the tax planning or advancement stages where you buy losses for future profit. So if I know I'm going to venture into a business which is going to generate huge profit, can I buy a loss-making company or company has a loss in the balance sheet where losses are carried forward and can be set off? Answer is no. You cannot. So technically this section is being designed in such a way that you're not allowed to buy losses for future profit. So you cannot take a company which is loss-making, change the ownership, get into a new business model, get more profit and set off your future profit with that. So that's not going to be possible, or they have put up a cap. So this section is being brought primarily to make sure that no one is allowed to buy losses for future profit. Quite interesting section, which aligns into various permutation which are seen in the various other part of the world. Now, no tax relief will be available for the falling losses, so you will not get a benefit. For non-tax period, that means if losses are incurred before the effective date of corporate tax, so corporate tax is not there, so why you will get a benefit of set off. Losses incurred before a person became a taxable for UAE corporate tax purpose. So unless and until you're not in the bracket of applicability, it won't turn out to be any benefit you're getting. For exempt or zero related activity or assets, so losses incurred for activity or asset which are generated, which generate income that is exempt from UAE corporate tax or zero corporate tax, again, that will not allowed. Losses incurred by free zone person that are not retributable to P in the mainland. So if your free zone is making losses, it's still a 0% rate, and they don't have a P in the mainland, so will not be. Now, these are interesting, again, a planning stage where you see the free zone company is a cost center and mainland is a profit center. So will it make sense to bring the free zone also as a taxable person? Definitely, because you will get a benefit of loss adjustments, you will get a benefit of group adjustments. So all those things becomes part of it. So, but you need to be proactive to declare a free zone to be a standard taxable person, which we talked in the previous stage, which you can do anytime. But once you do, there is no look back. You cannot go back and say that, sorry, I want to come out of it. There is no provision of coming back into that road. Now, this is interesting, again, as I said, losses and tax group has a lot of combination. So we'll pick up a tax group also, and we'll come back to the loss. Again, these are related sections, so I have intermingled a little bit to give a clarity on the subject. Tax group, now UAE corporate tax regime allows a full consolidation for tax purpose. That is tax grouping. So as we have seen in the VAT framework also, there is a tax group you can make. Now, in this case, it's essentially wholly owned group of companies. So 95% is a threshold which is being kept. So if a parent company hold at least 95% of the share capital and voting rights of its subsidiaries, then only you can form a tax group. That's a first condition. Now, there is one more category, which is not a tax group, but you are allowed to do a losses adjustment. Again, I'm referring, this is not a tax group, but you can do a transfer of loss from a profit-making group company to a loss-making group company, subject to 75% or more commonly owned. So for making a group, you need 95%. For loss adjustment, you need 75% common ownership. So that's a quite interesting point which they have brought into, and it's quite important because we have seen there are companies in the group where some companies are only cost center and some companies are profit center. Predominantly, you have seen in the construction sector where maybe you have seen all the visas are run in a company and they don't have any income, whereas all the income is earned in the different companies. So what we do for those transactions, we'll not get into cross billing and all that stuff. So that's a different subject. But there is a possibility, and that's why this legislation or this section is quite important to look at those part. Very important. Two are different sections. You are making a tax group. Second, you are not making a tax group, but still you are a part of a group company holding 75% as a commonly owned, and hence you will get the benefit of loss adjustment. Now let's look at tax group in a more detailed way. There are some sections or there are some pointers which need to be looked at, and we will see some examples also how the tax group can be formed. A UAE resident group of a company can elect to form a tax group and be treated as a single taxable person. If the parent company holds at least 95% of the share capital and voting rights of its subsidiary, that's a first condition. Neither the parent company nor any of the subsidiaries can be exempt person or a free zone person that benefit from 0% corporate tax. So if you're a 0% corporate tax, you cannot be part of a tax group. Either you give up your 0% corporate tax structure or you be out of the tax group. That's what the condition is. And the last is very small but a tricky one. All group members must use the same financial year. So please, if it's a group company, please look at the financial year from your constitution documents for each company. And if there are different financial years, start preparing and start getting amendment in your AOMA from a free zone authorities where you want to amend it to, or economic department if you want to amend it to. This is important to align in case you want to be part of a group in a future date. A subsidiary can also be part of the tax group if it's owned indirectly by the parent and subsidiary own at least 95% of the shares, or it has 95%. It is a UAE branch of a parent or one of its subsidiaries. So branch is not a separate legal entity. You can frame it out, but it should be not having a 0% tax benefit. That is what the condition comes into. 95% direct, indirect, both ownerships are covered as part of a tax group. Looking at quick scenario here, if you see there is a parent company which is in mainland. Sorry, just first one we'll look at. So here you have a parent company which is mainland and has a subsidiary which is 95%, which is in mainland. You have a 40% subsidiary which is in mainland. You have a 100% subsidiary with 0% corporate tax, and you have a 100% subsidiary with standard corporate tax. So when I say subsidiary, I'm talking about either in the mainland or in the free zone. So all the ticks can be brought up and made a same tax group. All the crosses are not allowed because first you have a 95% less subsidiary, so you cannot allow as part of the group. And then 100% subsidiary or 0% corporate tax. So you cannot allow 0% corporate tax as part of the group. Now, again, it's one of the critical factor I will say that we should have an ability to generate separate financial for each organization. So far, UAE was, before 2018, there was no tax structure. So a lot of companies having single financial books, whether they are related, non-related. So all those combinations we have seen in UAE market, although with the VAT implementation, a lot of things have cleaned up. But still, we are looking at a VAT tax group versus corporate tax group. Now they may be different because from a VAT tax group, 50% common ownership is a criteria. Here it's becoming 95%. So look at those intricacies. My first take is we should be able to generate separate financial for each organization, so that in case we need to consolidate at whatever level and whatever time, we will be able to do that. Otherwise, the complication may turn out to be a little heavy. Now, if you look at a financial year, again, if you have a Jan-December financial year in various companies and you have April-March in other companies, you may not be able to match up those companies. You have to look at both criteria. 95% less financial year common. So if both criteria don't match, again, you will not be able to bring up those companies as part of a tax group. So important, small point, but important part to look at and reassess whether we are in the right space or not, or is there some kind of amendment required. Now, once formed, the tax group is treated as single taxable person. So same principles which we have seen in the VAT era also. To determine taxable income of a tax group, the parent company will have to consolidate the financial accounts of each subsidiary and relevant tax period, and eliminate transaction between parent and each subsidiary group. So any income recognition or anything or transactions which are eliminated. Now here it's a similar liability, parent company and each subsidiary. Parent, we are talking technically in parlance with a representative company, and each subsidiary will be jointly and severally liable for a group corporate tax. So these are same principles we have seen in the VAT era framework also. So quite familiar and quite aligned with, I think, a lot of us. Now there can be some interesting transactions, which is transfer of asset or liability between member of the group. Now business, we keep reorganizing, we keep moving assets from one organization to another. We keep restructuring or reorganizing within the group. That could result in tax liability arising on realization of gains or assets, or liability being transferred. Now, should we tax it or not is a question mark which comes and become part of it. But I'll just give an example here also. We have a, yeah, we'll come on the example also in this case. So when there is a transfer of assets happening subject to certain conditions that we have transferred the asset at the book value, the transaction may not be taxed at the first stage. Now, what UAE corporate tax regime will allow for an exemption or deferral of corporate tax in respect of transfer of asset liability between members of the group. Now, how it will be done? Again, I will come back in those taxable scenarios in the further slides. But this is again as a part of a group structure which need to look at. Now, in addition, they have talked about some mergers, acquisitions, which keeps happening in various organizations to be undertaken on tax neutral basis. That is, no tax gain or losses arise, such that no tax or gain or losses arise. So there should not be a double taxation also, and not even ignorance of tax also, which will be looked at. So tax neutral basis is being generated in the further sections. I'll talk about that. Remember, we talked about loss adjustment. So one is group, one is loss adjustment. So both are a different category of cases, but have similarities. Now, you can do loss adjustment between the non-tax group companies, but having a common ownership of 75% or more. So you are not created a tax group. These are different entities, but you have a benefit of transferring losses from an entity to a profit-making entity, where the common ownership is 75% or more. That's what it comes into. Now, this is without tax group. Remember, there is no tax group. Applicable of group company that do not meet the minimum 95% common ownership required, or they don't want to form a tax group. Both conditions will be applied. So it's not a tax group. In that case, again, conditions which need to be looked at. You may transfer losses from one company to another. As a transfer of losses would result in transfer of value from the loss company to profitable company, one of the main conditions of failing group loss relief within UAE group companies are, first, 75% common ownership we talked about, and there should not be a company which is exempt or that benefit from 0% corporate tax. Same logic which we looked at in a group definition also. The total tax loss offset will not be allowed to exceed 75%. Same principle we looked at there. So you can adjust losses, but not beyond 75%. So they made a parallelance principle that a loss of a year can be transferred to another year, but subject to 75%. You cannot make 100% loss adjustment. Now, let's look at again an entity which is under loss adjustment, not a group. We have a parent company, 75% subsidiary mainland, 40% subsidiary mainland, 100% subsidiary but 0% corporate tax, maybe a free zone company, 100% subsidiary and standard corporate tax. So in this case, the second and third are not allowed because first condition, they are 40% subsidiary, that is less than 75%. And second, there are 0% corporate tax. So you cannot make a loss adjustment with those entities. But yes, parent, 75% subsidiary and 100% subsidiary, these three entities can make a loss adjustment between each other. You don't need to be part of a tax group, but definitely documentation and transfer of losses need to be proved. Now there are conditions which plays. So we have done a loss adjustment, fine, but this should not be only for a one-time or a planning perspective. So again, KYC becomes important. Intra-group transfer relief will be available for transfer of asset liability between UAE resident companies that are at least 75% common owner. So remember, we talked about, can I transfer the assets and liability to other company? Answer is yes. Without a tax group also, yes. Within tax group, there's no problem because within tax group, anyway, it's considered as a one entity and you set off any kind of intercompany transactions. So there is no challenge. The challenge comes when this is not a group tax group company, but there is a 75% common ownership. Now, the two conditions which are required to be met and will be reviewed every year will be, one, the asset and liability being transferred remain within the same group for a minimum of 3 years. So once you transferred and maybe you have gained in one company, you earned the millions of dollars of money, no problem. You don't end up paying taxes, subject to you don't transfer that asset for next 3 years. Second, the transfer should be at a net tax book value. That means if let's say book value is today 1 million and the commercial value or market value is 10 million, you will not transfer the asset at 10 million value. You will retain the asset in the new books of 1 million only. Logic is you're technically deferring the taxes. You're not eliminating the taxes. So what will happen if I transfer the assets now? The tax of 9 million, which should have been paid as tax, got deferred to the other entity. So whenever they sell those assets at a later stage, whatever taxes come can be paid into. So that's a very important part. So any loss and gain, there is no book entry of loss and gain also, which is recorded. Now, where relevant conditions for intergroup relief do not continue to meet, let's say on the second year, you sold the asset or the common ownership is being broken, then you have a problem. That means you have to pay tax in the period when the condition ceases to meet. So 75%, you cannot reduce it after that. If you reduce, you end up paying taxes. You cannot sell asset to the other out of the group. If you sell asset, you end up paying taxes. So that's a condition which is being kept into. So I'll use a word. This is not a elimination of tax. This is only a deferment of tax. So you end up deferring the tax to the next period, or the entity will end up paying a taxes at a later stage. Interesting section, quite a lot intricacies I think will come up into the rule book also in this. So quick example, company A, asset and liability sold to company B, condition, transfer assets should remain within the same group, that is complying to 75% ownership rule for a minimum of 3 years. Transfer is at a tax net book value, so there is no profit or loss being earned or gained in the books of any of the company. So it's only a deferment of tax which has happened in this category. Now, again, reminding everyone that this is happening without a tax group. So you're not created a tax group of VAT, of a corporate tax, but you have a common ownership, and that's how you're taking the stance of transfer of asset. In case of ownership change within 3 years, may attract tax on commercial price. So this is where the catch is. If you believe that you will not be able to retain that asset for a long time and the commercial value is going to jack up at a later stage, better you pay the taxes and relax. Otherwise, you need to look at this principle. Maintaining KYC is again becoming an integral part, or UBO is becoming an integral part of this tax planning. So whenever you are buying shares between the companies or group company, make sure that you have not taken a tax benefit in the previous period and end up losing that tax benefit or getting into a wrong direction. Now there is one more section which is being provided. Again, I'll use a word. This is again a deferment of tax, which is a restructuring relief. To facilitate mergers, spin-off, and other corporate restructuring transactions, the UAE corporate tax will exempt or allow to defer taxation where a whole business or independent part of the business are transferred in exchange of shares or other ownership. Now, there can be various sectors, various categories. What I've taken a small example. Asset is held by individual, including sole establishment example, and he's selling or transferring the asset and liability to get a shares in a new established LLC. So there are 2-3 people or single person LLC also, both are fine. So that is where it goes into newly establishment LLC. In this case, if these conditions are met. Now, what conditions are this? Point number 1, asset and liability being transferred as part of qualifying restructuring will be treated as being transferred in the tax net book. That means you're not booking a profit. Again, what we referred in the previous 75% story also, you're only deferring the tax by transferring the asset. Any restructuring relief will be clawed back if within 3 years of the restructuring, there is a subsequent transfer of business to the third party. So ownership is not changing, same logic of 3 years being used. And if you do, then you end up paying the taxes at that stage. So again, restructuring relief, 75%, group anyway have a benefit of any any transaction happening between the group will not be treated as a sale or purchase, and hence no profit will be arrived out of it. Okay, coming to other interesting sections. Now this is where all the director remuneration, other parts becomes part of it, and we will cover up those points. Transfer pricing is playing an important role, which can be instrumental in a tax planning. Why? Because individuals are not taxed, corporates are taxed. So what we do and how we do is an important part. So UAE corporate tax regime will have a transfer pricing rule to ensure that prices of transaction is not influenced by the relationship between parties involved. In order to achieve this outcome, the UAE will apply the international recognized arm's length principle to transaction and arrangements between related party and with connected person. Again, I'm using a critical word, KYC, know your customer, know your shareholder, know your director, all those things becoming part of it. Related party is stretched quite interestingly in this section. So if you see related parties, who are the related parties? Generally, it's used as a very small analogy, but this corporate tax is taking 4 degrees of kinship or affiliation. 2 or more individuals related to the 4th degree of kinship or affiliation, including by birth, marriage, adoption, or guardianship. Now you need to know who is son of whom and who is the daughter of whom and who is the stepmother, stepfather, stepdaughter, stepson. So all those things has to be taken into consideration whenever you are doing any transaction which is not of a commercial value or where there's a discount being provided to. Now, 4th degree of kinship relationship is a brother, sister, uncle, aunt, first cousin, grandparent, great grandparent, great aunt, great uncle, great great grandparent, niece, nephew, grandniece, grandnephew, and or step parent. So the definition is quite huge, and I don't know how we'll have a family tree. So for all the people or all the relationships, you need to have a family tree looks like, and need to assess. I think this is especially important where you have a transaction which is not a commercial transaction. So anything you are doing at a discounted or at a premium price, either you're paying or receiving, need to be looked at quite extensively. So this is where related party comes into play. Now this is based on relationship. Next comes an individual and a legal entity where alone or together with a related party, the individually indirectly or directly owns 50% or greater share or control in the legal entity. Again, it comes to related party. So if a husband, wife are holding a ownership, since this is part of a 4th kin, that's we talked about a related party, we need to bring that also back. So related party, you have to go back to the previous first definition also and see whether they are individually, directly or indirectly hold 50% or greater shares or control. So 2 or more legal entities, 1 illegal entity alone or together with related party directly or indirectly own 50% or greater share in the control or the legal entity. So now the story is coming up. You need to find the UBOs, because unless you find UBO, it will be very difficult to establish whether the warm bodies, when I say warm bodies, people who are living and kicking, are owing 50% directly or indirectly. That means with themselves or with the related people, family member, which we talked about in the previous slide, 50% plus control. So all those structure comes into play. So the based on ownership control. So first is relation, second is ownership control, but again, ownership control also have an element of relationship. Next comes a related taxpayer and its branch or a permanent establishment, because these are anyway related, because if you have a parent company and a branch, there is a relation. If you have a parent and any kind of a permanent establishment, there is a relationship. Partner in some in unincorporated partnership. So if you are dealing with a company and they are selling or buying to an unincorporated partnership where the shareholder is common or ownership is common, again, it comes as part of a related party transaction. Exempt and non-exempt business activities of same person. So one income is under the 0 category, one income is under the 9% category. So any relationship which is happening between these two parties, anyway, it's held by the common ownership. that criteria also comes, but you need to look at, is there a passing on of expenditure from 0% income to a 9% taxable income. So all those transactions comes under the preview of a transfer pricing or the fair pricing mechanism based on commercial connect. So that's a three thing which we talked about. So first is based on relationship, family members, we referred to. Based on ownership, shareholding and control of 50% or greater, and based on commercial connect. So any of these three things, if referred to, you need to look at it. Now, this doesn't stop here. This goes further. So this is what I refer to. Important to do a full KYC CDD for a buyer supplier, especially where you are getting a better deal, which may attract arm's length principle. So I don't know how will we stretch it out, but this is a little bit of open point which need to be looked in more detail. Any non-commercial deals need to be looked at in a much more granular or detailed way. Now, that does not stop here. Now, this is related party we talked about. Now we are talking about connected person. So any connected people, now shareholder, director, manager, officer, if they are connected with any relationship with any buyer, supplier, or related entity, that also comes in part of the principle which we are talking about. An individual who directly or indirectly has an ownership interest or in control the taxable person, director or officer of a taxable person, and the individual related to owner, director, or officer of a taxable person to the fourth degree of kinship or affiliation, including by birth, marriage, adoption, or guardianship, where a taxable person is a partner in an unincorporated partnership or any other partner in the same partnership, a related party. So it comes quite heavily on first defining who are the people who comes and becomes part of it. So all those sections need to be looked at. So first we looked at, we have not even started looking at what is arm's length principle, but related party and connected party is an important definition. Now, to comply with transfer pricing rules, the arm's length principle set out in OECD transfer pricing guidelines need to be followed, which is quite extensive. The result of transaction or arrangement must be consistent with the result would have been if there have been no relationship between parties or they're not related to each other. So that's where the pricing difference comes and need to be looked at. The arm's length principle will need to be determined using one of the set of internationally recognized transfer pricing method or different method where the business can demonstrate that the specified method cannot be reasonably adopted to determine an arm's length result. So this itself is going to be a good action plan from proof perspective, where profits are being shifted and where tax authorities will look at a documentation side. BEPS Action 13 talks quite extensive on transfer pricing. I think we can have maybe a full session on the transfer pricing itself. So I'm not getting too dwelled into it, but I've given a source from where OECD you can pick up the transfer pricing guidelines. CBC, especially for MNE entities, which is more than 750 million euros, are already covered into the BEPS action plan, and they are required to report the requirements which will be specified into. Where relevant, the business will be required to submit a disclosure containing information regarding transaction with related parties and connected person, which is anyway part of the audit financials also. The business will also need to maintain a master and local file. Now, this is predominantly for entities which are more than 750,000 million euro, where transactions are defined into the CBC reporting, country by country reporting. UAE has introduced that also. So that's what we talked about, transfer pricing or framework which need to be looked at. Coming to a lighter note, rate of tax, simple, up to 0% up to 375,000 and 9% above 375,000. How we calculate the tax liability? We looked at the section first, final taxable income, which you saw, which we have arrived in the previous sections. You see whether the tax is between 0 to 375,000, zero tax, more than 375,000, calculate at 9%. Tax liability is technically B. Reduce any foreign tax credit. Now, what is foreign tax credit? We'll come back again. And if you reduce the foreign tax credit, the final corporate tax which comes is a payable one, which will be submitted and paid to the authorities. Now, what is foreign tax credit? So if you are having a branch or a subsidiary which is outside UAE, that branch or subsidiary will be subjected to tax in those countries. The tax which you pay in that foreign jurisdiction is, in a very simple form, called foreign tax credit. Now, to avoid taxation, UAE corporate tax regime is allowing credit of taxes paid in the foreign jurisdiction, but subject to only within the income of that category. So you have to have an income calculation of foreign tax, foreign income, calculate within 9%. If the foreign tax is more than 9%, up to 9%, you just remove it out. But you cannot take extra credit of extra amount paid. Example, your subsidiary is in the jurisdiction where tax is at 24%. You cannot claim full 24%. You can only claim up to 9% of the category which we are referring to. So the maximum foreign tax credit available will be lower of the amount of tax that is paid in the foreign jurisdiction or the UAE corporate tax payable on foreign source income. So it's important to have a separate financials is what very clearly comes into. So the calculation has to be very clear on how foreign income is sourced and what is the corporate tax coming up. And you have to use the same principle of inclusion, exclusion of expenses in the foreign sourced income so that clear articulation can be brought up. Any unutilized foreign tax credit will not be, you will not be able to either set off or carry forward to any other period. So, and there is no refund which is going to come up to extra taxes paid. So it's only a benefit of what you paid. So within the framework, you can reduce that value. Coming back to example, simple. If you have an income of 400,000 up to 375,000, it's a zero tax. Above 375,000 is which is 25,000. You end up paying 9%, which is 2250. So technically speaking, if you see, it's a very small percentage. It's not even 9% based on the income earning which you are going to get into. Yes. Will there be a different reporting and tax obligation requirements? Answer is yes. In order to support startup and small businesses in UAE and to manage the compliance burden of those taxpayers, UAE corporate tax regime says that intend to provide relief for small business in form of simplified financial and tax reporting obligation. Now, how it will come, we have to wait and watch. But this is certain that it will not be a standard approach which will be used. Now, this withholding tax is an interesting section. Looks quite unimportant, but it's quite important, especially where you have a cross-jurisdiction transactions. Remind ourselves, we have to that 0% tax is again a tax, and hence you get a benefit of income being taxed in the jurisdiction. So 0% withholding tax will apply to domestic and cross-border payments made by UAE businesses. UAE business will not be required to make any deduction from payment made, nor they will be obliged to file withholding tax return. So there is no withholding tax return, but withholding tax has to be applied. So in the previous Q&A, it was stated that withholding tax will not be applicable, but the clarification or saying further information which comes is withholding tax will be applicable, but there's no obligation to file any withholding tax returns as a section. Some quick examples and of the type of income which can be UAE source income by a foreign company that is not attributable to a PE in the UAE of a foreign company. So foreign company does not have a PE, but he earns that entity earns a UAE income. So example is foreign fees paid to a foreign company. Professional fees paid to a foreign company comes into this category. There will be a withholding tax, so tax is paid, but it will not require to file any kind of returns or submissions by the deductor from a UAE company. Mainland UAE source income earned by a free zone person that benefits from 0% corporate tax regime unless income is attributable to mainland branch or free zone. So the quick example comes is income from mainland, which is passive in nature, includes which we refer to interest, royalty, dividend, capital gain, or owing shares in mainland. So that's where this comes into. Dividend and other profit distributions made by free zone person that benefits from the 0% corporate tax regime to mainland UAE shareholder in the free zone. So in this case, if a free zone pays any dividend to mainland company, which is a shareholder, again, it is a 0% corporate tax, withholding tax will be applicable. So that's what withholding tax quick discussion. Although there's no benefit, no coming up, but 0% tax regime will have some bearing in the international tax treaties. Quick snapshot, 2-3 sliders on international tax development. This is a very specific to large or very large corporates. I will use a word. There are 15 BEPS action plan, which are action 1 to 15. You can see on the slide, which goes till multilateral instruments, country by country reporting, BEPS data, transfer pricing, permanent establishment status. So all those sections which we refer to directly or indirectly are part of it. Technically, BEPS framework or 2.0 has 2 pillars. Pillar 1 majorly focus on consolidated profit of a multinational enterprises in the jurisdiction where sales arise. So that was a major focus, how marketing expenses are booked, what kind of income is derived into. And pillar 2 is going to introduce, I'll use a word, where global minimum effective tax of 15% is brought up into. UAE is also part of the framework. UAE has signed in October 21, where more than 130 countries are part of the BEPS framework 2.0. So as I referred to, it is applicable majorly for entities or for the entities where they have a euro 750 million plus reported revenue. So we are talking about a reported revenue where this reporting period starts. So UAE, so before even the taxation or the pillar 2 applies, the CBC reporting starting, which is technically part of a pillar 1. Under the country by country reporting, the entities are giving a profitability structure or the revenue structures in which organization what revenue and what profits are achieved, to make sure and to highlight how the substance is working and how the structures are working on shifting the profit from a high tax jurisdiction to low tax jurisdiction. Pillar 2 is still under the process and it's getting worked into. As we looked at a lot of steps for compliance, and I can say all these are connected. I'm certain that corporate tax is not a standalone tax to be looked at. If you look at, we started in 2018 majorly, I will use a word, I will not say it's only that. Value-added tax got into place in May 2018. Inclusive framework of BEPS came into place. 2018-19 AML CFT framework came up. 2019 CBCR reporting came. 2019 again economic substance came, and 2020 beneficial ownership started picking up, and 2020 corporate tax. 2023 corporate taxes is going to highlight a very big story. So there are going to be further sections. I'm not detailing out those pointers, which is on registration and deregistration. Too early to talk about those points. Filing payments and refunds, again, too early to look at that section because we are still in the pre-planning stage. Financial year, we talked about, you should look at which is your financial year and how your corporate tax is applicable. Returns and taxes will be due from 9 months from the tax period, or a payment need to be made. So if your financial year is, let's say, ending in December, so then 9 months, that is September, before September end, you need to file your tax returns, and you need to make sure that tax payments are also made. So tax audit has to be completed, tax audit has to be technically completed, and make sure you file your returns on time in that way. So that's a broad action plan.